We're living in an interesting moment for the US economy with record-breaking stock indexes, Wall Street scrambling to raise forecasts, yet under the surface it's just a little weird out there. So today we're going to be breaking down what's happening with the markets, why major institutions are all of a sudden changing their predictions, and how new tariff threats could impact inflation. And we'll also check out what key events are coming next week that could make markets move in a big way. So let's get into it. So overall, it was a pretty flat day across the board for the markets. The S&P 500 reached a fresh record, but despite that new record, it closed lower along with the NASDAQ. And the NASDAQ's kind of been struggling a little bit. It's been on the struggle bus. Maybe this is in relation to the news on possible tariffs that we can be expecting pretty soon. Word from Trump. The Dow Jones Industrial Average was able to end out the day in the green territory, but all of this is just noise. And we talk about this all of the time, but in just the past month, at least 7 of the major Wall Street banks, including Goldman Sachs, UBS, Bank of America, Wells Fargo, all of them have raised their year-end targets for the S&P 500. So Citigroup now sees the index at 6,600 by the year-end, which is up from their 6,300 forecast previously. Goldman Sachs also bumped their target up to 6,600, citing earlier and deeper Federal Reserve rate cuts and strong fundamentals for mega cap stocks being the reason why. Oppenheimer Asset Management is the most bullish, raising their target from 5,950 to 7,100, implying nearly a 10% upside from current levels. So they're pretty optimistic. And even with all of these upgrades, the average year-end target across the Wall Street board is 6,400, slightly below where we are now. And that's a red flag that some strategists think we may be overextended based on. So how do they calculate these targets? These numbers aren't just random guesses they pull out of a hat like a rabbit. Most strategists calculate targets by multiplying the estimated earnings per share, the EPS, for the S&P 500 over the next 12 months by its forward price to earnings ratio. So the earnings per share is the company's profit divided by the number of shares outstanding, and essentially how much each share earns. So the PE ratio, the price to earnings ratio, is the price of the stock divided by the earnings per share, which is a measure of the valuation. So when both the EPS, the earnings per share, and the PE, the price to earnings ratio, so the EPS and the PE are rising, targets go higher. So right now, 81% of the S&P 500 companies have reported above average earnings above their estimates. Now, that's well above the 5-year average of 78. We just said 81%, so 78's the average, 81 is where we're at right now, so it's looking pretty good. Now, look at this though, because Berkshire Hathaway's been making some moves, and even with all of the market optimism, Warren Buffett, who is the main player here, despite his buys, people still see caution within the last quarter. So they bought less than they have with $2 billion in stocks and sold $4 billion in Apple shares. So they sat on a cash pile of $344 billion that everybody's been watching for them to make a move on, and this is more than a third of their entire market value. And what this tells us is that Buffett doesn't see any bargains right now. And for regular investors, it's just a reminder that market euphoria can mask underlying risks. And a lot of people's been waiting for Buffett to really swing in and start buying up stocks. Hey, Buffett, can you go buy Tesla stock? Can you buy up Robinhood stock? And he's not really into buying what he doesn't understand. And with him retiring soon, I don't know if he's going to make any big moves entirely anyways, but I'd imagine they're waiting for something to happen and them to acquire up entire companies for a bargain of a deal rather than just buying up 1% of a company. So let's get into tariffs and related tensions and inflation. So President Trump recently hinted tariffs on certain imports that could rise as high as 300%. specifically mentioning chips and steel. And I think this is why the NASDAQ has been kind of fumbling lately, because a lot of these tech companies are dependent on chips and steel. So the steel is used to build these huge data centers, and the chips, like, that's what's leading the AI cringe. So that's really important. So higher tariffs raise the cost of imported goods, which can fuel inflation, measured by Consumer Price Index, the CPI. So in August, consumer sentiment fell to 57.2 from 61.8, the lowest in 3 months. And people now expect prices to rise 4.9% over the next year, which is up 4.4% in July. And even though the current inflation rate is currently 2.7%, expectations matter because they can influence actual spending and pricing behavior, because it almost self-fulfills itself. Now, back to the tariffs a little bit. If these tariffs keep on raising costs and raising costs and raising costs, and the stock market keeps reaching new all-time highs and new all-time highs and new all-time highs, if these companies like Nvidia, AMD, Intel, Taiwan Semiconductors, all of these huge AI plays that are kind of in a way propping up the market, in some people's opinions, I mean, Nvidia is such a large percentage of the S&P 500 and the NASDAQ 100. If these tariffs start raising problems for some of these larger tech companies and they start struggling because now there's all of a sudden this 300% tariff on Nvidia and AMD, and these companies start falling, what happens to the broader stock market? So just ask yourself that. Now let's talk about retail sales. So retail sales, a measure of consumer spending at stores, online, and in restaurants, rose 0.5% in July from June. And that's exactly what was expected to happen. Auto sales led the way up, being up 1.6%. Maybe rates falling a little bit. People trying to scoop up some deals. Back to school. Got to get my kid to school, or they need to get themselves to school. Furniture sales, which are tariff sensitive, climbed 1.4%. And this is really what some are describing as a Goldilocks scenario, which isn't too hot, not too cold, keeping hopes alive for a rate cut from the Fed next month. Now, I think that a Fed cut next month is, I guess quote me for it, but guaranteed at this point. It's just, are we cutting 25 basis points, or are we going for the 50 basis points and off half of a percent? The PPI data we got, what was it, yesterday? So on Thursday, some are saying that kind of blew our odds completely away of a 50 basis point cut. So it's really up to this 25 basis point cut. But I'd imagine it's pretty much guaranteed at this point. But a lot of it's still dependent on how next week goes. And let's talk about some of what we got next week. So next week is going to be loaded with a lot of market moving events. So Wednesday, we get the meeting minutes from the Fed for July. Thursday, we got US PMI surveys on manufacturing and services, which will be the first real read on tariff impacts. Friday, we'll get Jerome Powell's speech at Jackson Hole Symposium. And a lot of people are going to be watching this one because this is what they're saying is backing his legacy. He's probably going to defend not cutting rates. But we'll keep on watching what happens, because right now futures are pricing in around a 93% chance of a 25 basis point cut in September. But Powell's tone could shift that expectation dramatically depending on how it all goes. And that's not just the end of it, because we still got other things happening happening next week. So I'm pulling up. Yeah, there we go. So, look, let me see real quick. Stick with me. Home builder, confidence index, a whole bunch of real estate stuff. So housing starts, how many projects have started, how many people are planning on starting projects with permits, because usually got to apply for the permits and let the city know what you're planning on doing. Meeting minutes, we just talked about that. Initial jobless claims. Existing home sales, U.S. leading economic indicators. So that's kind of what everybody's going to be watching next week, but mainly Jackson Hole. Highlight, underline, circle, embolden that one is that's like the Super Bowl right now. So we'll keep on watching that. So we've got a market hitting record highs, Wall Street turning more bullish, yet the smartest money, like Buffett, for example, is sitting on the sidelines still. And people say that they're chasing different types of sharks. They're not like your average retail investor who's buying maybe like one share of Tesla at a time. Like, they're trying to acquire entire companies, so they are from a different POV than we are. Tariff tensions are building, inflation expectations are rising, and next week could prove to be pivotal for the Fed's next move. And the question is, will the rally keep running, or are we about to hit a wall of resistance? If you found this breakdown helpful, make sure to like, subscribe. Let me know, man. I'm trying to get better. Drop a comment on your take. What do you think? Do you think the S&P 500 will finish higher this year or lower than where we are right now? Let me know down in the comments. I'll see you next time.